points today. When you trade a small contract in the Dow, you're trading literally $5 per point. So on a 100-point range day in the Dow, you're talking $500 range. There's silver, there's gold, there's grains. There's all types of electronic contracts and also contracts that have reduced sizes. And these products also have options, which we'll cover a little bit later, but as some Forex companies now are offering some optionable positions on foreign currency trading. But as far as futures is concerned, it is more just like Forex. It's short-term in nature. Trades last from as little as possibly 1 minute or less to 1 week, up to as much as 3 months for most traders, based on a quarterly ending cycle in the futures for most products. And we'll show you about that. That's called the rollover. With the foreign currencies, I got news for you. The futures is a little bit more complex. Futures does offer day trading, swing trading, and position trading opportunities through the use of course, margin and even options to hedge your risk. Forex, it is more geared towards day trading and possibly swing trading 2-3 days. Therefore, in day trading, we need to apply momentum techniques, technical analysis, and that is what we're looking to employ for our bulk of trading in the Forex market. So if you're a Forex trader, you're just looking to capture a move in the market, you're looking to profit from that move, and you're looking to take the next opportunity as you see. Now, no speculative investment is safe, whether it's futures or Forex. So first off, all leveraged investment and even non-leveraged investment vehicles are risky. So it was once told to me that your safest investment is in yourself, in your own career. So whatever that career is, and if you're not yet a professional trader, then remember, using Forex is a great means to supplement an income, or at least to get yourself into taking control of your financial destiny by looking at other opportunities as far as investments are concerned. As far as futures, remember, they have margin calls, and you also in futures run the risks of what's called debits. You can actually lose more than you invest through various market conditions. In Forex, there's also risks inherent with trading with the leverage system, but due to the fact that the foreign currency markets and the interbank market is so vast and so deep and the liquidity is so high, running a situation where you're going to run a debit is so remote that under most circumstances you could literally be taken out of the market in a moment's notice. And most foreign currencies platforms have that feature known as a kill switch, so to speak. Now, Forex has uniform contract sizes, and that's one of the neat things about Forex. In fact, analytically speaking, Forex is really better to trade than the futures for first-time startup traders. In fact, the reason I say that is this. Number one, as I just mentioned, all contract sizes are uniformed. In the futures, different various contracts and markets have different contract sizes, and therefore every tick or pip value is different. As we have in your trading course, we've listed the different markets and why they're different, but and different pricing, such as, for example, Canadian dollar in the futures, $10 per point. The euro currency is $12.50 per point. You have the British pound, which is $6.25 per point, and that trades in half tick or double tick increments. So already, as you can see, it's a little bit confusing. How many contracts do I need? What's my margin? These are things you have to figure out. Trading, your main focus should be, I have a signal, where should I get in, what's my risk, and what's my profit objective. With the futures, you need a little bit more study and involvement in actual knowledge of what the market and the contract sizes are. Another thing about Forex that is truly a great benefit is that we don't have what's called rollover. Every quarter we see a new contract begin, such as we call the rollover period, which takes place the second week of every June, September, December, and March. In the futures, we're trading a March contract, and then as we get through the second week of March, generally speaking, about the second week of March, we have to roll over from a March futures contract to the next quarterly ending cycle, which is the June contract. As we get to June, then roll into September, September, roll December, and then once December passes, we go into March. Now, why is that such a problem? Well, if you're